We'll discuss the theory content under accounting. The first content we are going to discuss over here is on concepts or the principles. See, for each and every paper, we'll be naming something called as vocabulary, right? Same like when we talk about accounting, these are called as vocabulary, okay, which means you cannot use your own terms. So in that way, we'll come across the principles. So probably you might have done with the problems. What do you mean by principles? We have the money measurement concept, we have the matching principle, and we have to apply all those concepts while dealing with the transactions. When we say principle is applied for not recording employee efficiency, okay, it's only we are going to talk about in monetary terms. So that's the very first principle. Let me number it. First principle here we are going to discuss is money measurement principle. The first one is money measurement principle. Only those items which can be measurable in monetary terms will be recorded. See, when we talk about financial statements is talking about figures, not the characteristics. Probably you may ask me, what about goodwill, ma'am? Yes, obviously goodwill is need not be exactly in monetary term, but that can be valued. And we have the accounting treatment for valuation of goodwill also. Okay. So even though this seems to be non-monetary in feature, if we can make this into a value, monetary value, then that can be recorded in the financial statement. So what they say is, you cannot say whether a number is good or bad. You have to measure the number and you have to put the figures only. So in that sake, if you want to talk about employees' efficiency, so that's the question, right? Principle is applied for not recording employees' efficiency in financial statement because that's not in monetary term. If you want to measure the skill or loyalty or morale of the employee, they are qualitative. That is about the features of the employee, characteristics of the employee, which will not be recorded. Is it okay? What other accounting principles we know is the second principle is prudence principle is for inventory measurement. Usually inventory are valued at, yes please John, lower of cost and net realizable value. If I sell that inventory today, at what value it will be realizable? And probably you might be knowing this concept, gross and net, right? What is the difference between gross and net? From the gross, okay, if you deduct some figures, you'll get the value which is called as net value. Am I right? The third one is matching principle concept, probably for rent payment and all, or rent you receive the rent. You will be using this concept, which is matching to that particular financial year. So you will be charging the rent for that current year, which means the financial year is from April to March, right? April to March. Any payments made before should not be taken for this one, and any payments made after should not be considered for this one. So advance payment and outstanding should not be missed. So it should be adjusted for prepayment and accruals. Accounting principles for not including in financial position statement, probably inventory of price labels. Either you go with materiality or prudence. Skills of a salesman. Okay, what you have to do? You have to go in terms of money measurement principle. There is another one concept. Actually, this is not going concern. I request you to make a correction here. This is with respect to financial statements only. If you talk about financial statements, how far it has been useful for the external uses, for a bank manager, how you'll be taking the help of this one to check the ability whether we can make the loan payment or not. Say I'm borrowing loan from a bank. Is the bank is going to invite you? Is going to come to your house and give the loan? No. The bank will obviously check whether you have filed your tax bills, etc., etc. What is your income per month? How can you manage the amount? Because after all, how the bank is getting money? Because the public are depositing the money. It's not the bank money, it's the public's money The citizens have deposited the money and the bank is lending the loan to me. Am I right? So the bank should be very cautious while lending the loan. So how the bank manager will check here? We'll check whether we are able to repay the loan or ODs of interest from where? From the financial statements. What about the government? It will check whether we are paying the tax at the right time when it is due. What about trade payables? To confirm whether debts will be settled or credit terms will be safe. Even though, if you talk about another one person over here, probably you can talk about investors or shareholders. Seeing the financial statements only, you will plan whether you can invest or probably you might have invested already. And you see the financial statements, it's making loss, 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 loss. What do you do? Immediately you take out the investment from there. So disinvest, right? The reason for recording irrecoverable debt will follow the prudence principle. Profit or assets sometimes not overstated. Losses and liabilities should not be understated. Irrecoverable debts should be written off. Why? To prevent overstating profit and or assets. Is it okay? Owner's personal expenses from business bank account. What do you treat this as? Owner's personal expenses from business bank account. You call this as drawings. And this is followed from this principle called as what? Business entity principle. I think this is the fourth principle, right? Can you give the numbering? First one, we did is money measurement principle. Money measurement principle. Second is prudence principle. Yeah, thank you. Third is matching principle. And now fourth, we are dealing here with business entity principle. What this principle says is, when a person starts his business, the business is separate from owner. When a company is started, incorporated, business is different and owner is different. Transactions should be recorded from business point of view only, and drawings should be recorded correctly to avoid understating profit and overstating capital. Is it okay? Also, when you talk about business, they'll be maintaining the documents and some errors will be occurring. So the next heading is about this one. Directly debiting for insurance, the bank statement. Error of principal has to be considered. Capital item is treated as derivative item and the vice versa. That should not be done, right? You buy a car. It's a capital expense or revenue expense? It's a capital expense. You fill petrol for the car. And you say, "Ma'am, only if I fill the petrol, the car will move on." So that's a capital expense. Right? The car has an engine and the engine is now not running. Only if you replace the engine, the car will run. Ma'am, that's what I said, ma'am. Only if you fill the petrol, you fill the fuel, ma'am, the car will run. So the petrol is capital expense? No. But the engine is the capital expense because you have to replace the engine, you have to make the engine run. Then only what will happen? It will work in a condition. So replacing the engine is the capital expense, whereas filling the fuel is not a capital expense. So also, how you segregate this one? Capital or revenue? If it comes for more than a year, right? Suspend account balance remains means not all errors are corrected. Is that right? Suspend when you create a suspense account, because when you are not able to tally, you create a suspense account. So this is one content. Let me go for next content on bookkeeping. Bookkeeping, books of prime entry. What are the different books we maintain? Petty cash book, sales journal, sales return journal, purchases journal, purchases return journal, and general journal. So right. What's the advantages of using books of prime entry? Probably that will be helpful to prepare control accounts. It will assist in collating and summarizing the info. So you'll get a complete info there. It will remove detail from the ledgers and bookkeeping can be divided among the staffs. Next we'll go for double entry system, double entry bookkeeping system. Why you keep double entry records? So whenever you have passed a journal entry, what you might have done? A debit entry and a credit entry. Am I right? So what are the advantages behind this? You'll get the full details of assets, liabilities, revenue, and expenses. How did you get the asset? Okay, you paid the cash and got the asset, or you gave something else and you got exchange in terms for the asset. It will be easier preparation for financial statements That's why we are talking about tallying the balance sheet, right? The profit which you do by following this bookkeeping system will be reliable, and also the loss figures will be reliable, and it will be helpful for better decision making, and greater control will be received over the activities. Also, yes, fraud risk will be reduced. Not only that, you can compare with the past year records and other businesses also. So your company A, let me name as company A company. There is another one company, B company. This company is preparing the financial statement balance sheet. So for the year ending March 2025, they have prepared, and also they have the balance sheet for the year ending March 2026. Okay, which means you can compare both the figures and you can tell whether the assets are increased or what other things. You want to compare for the year ended March 2026 for A company and B company put together. Yes, you can do that. That's what they are mentioning here. Detailed records will be available for reference and information will be readily available for banks and lenders. Also, we'll come across this trial balance and journal entries. Trial balance, what is the other uses? It will help us in preparing the financial statements. Whereas about the journal, will be having the opening entries. This will have past journal entries like correction of entries and all. Purchase or sale of non-current assets on credit. Non-regular transactions will be recorded. Year-end transfers to income statement. We will be recording the depreciations. You will be writing off the irrecoverable debts. We will be creating or adjusting provision for doubtful debts. We'll call this as PDD, right? Provision for doubtful debts. Contra entries like sales ledger, purchase ledgers will be there. Drawing of goods or non-current assets also will be. Let us go for the third content on financial statement. How the bank managers are interested in financial statement. Already I discussed this more. They'll assess what is your ability to repay the loan. They'll assess what is your ability to pay the interest, whether you can pay it. They'll also check the security available, what are the assets you hold, you have any jewels or whatever it is. Evaluate profitability and liquidity and judge risk before lending. Okay. Because it should not become a non-performing asset. Okay, you remember? What do you mean by non-performing asset? You have heard this term, NPA. Just imagine there is a bank called a C bank. Okay? C bank. Just for example, I'm saying there's a bank called a C bank in one particular nation. This bank has given vehicle loan to already two persons. Okay, let me name the two persons as X and Y. Okay? This X person now could not be traceable at all. This Y person traceable, but he does not have the vehicle in hand. He does not have any cash in hand, almost insolvent. Okay. Is it possible to get the loan record from X and Y? Not possible. Okay. What is NPA? Non-performing asset. Okay. Next is limitation of financial statement. Probably it will influence the decision to reduce the selling price. Okay. Probably I might be divesting my investments. Must consider profit earned since year end and must consider current inventory levels, not just year end figures. How far you can rely on the financial statements even if errors are present? See, sometimes errors will be present, and how we are going to make sure that we can rely on the records and we can proceed. Errors which are not materialistic or significant, overall reliability is maintained, and sometimes minor mistake will not have a big impact on the true and fair view of the balance sheet. Okay? Users can still rely on statements for decisions. No inventory, probably provide service but not goods. So you're not having holding inventory, right? Client supply own cleaning materials. Yes, obviously that also happens. No provision for doubtful debts for non-revocable debts. So probably you'll cancel this no and irre, which happens like what? Recoverable debts. Very few trade receivables, less than a week's revenue. So you'll not create this provision for doubtful debts. Some customers, yes, this happens, right? They pay in advance. So in that case also is not necessary. Let us go for next content, control accounts. Control accounts help us to locate the errors, proof of arithmetical accuracy of ledgers, provides total of trade receivables or payables instantly. Not only that, it allows to draft financial statements quickly. It summarizes the receivables and the payable transactions and may help to reduce fraud. See, how can you remember this control accounts point is, here can you find this fourth point allows to draft financial statements quickly. So what are the advantages you have for financial statements? Almost everything you can list it over here, right? Next content is on depreciation. Depreciation method change to reducing balancing method. Advantages: matches asset use, higher loss, earlier years. More realistic valuation of vehicles will be there. Yes, obviously, if you're using it for 1 or 2 or 3 years, the value of the vehicle is reduced. Reflects actual fall in value. Is appropriate for assets with rapid early decline. It lowers depreciation in later years, like higher profits later. Aligns with matching principle for that year, right? But there are some disadvantages also. It's complex to calculate annually. Higher expense in earlier years, lower profits initially. Yes, obviously, you have started your business now. Probably for the first 2 or 3 years, you will not get the profit, but you have to depreciate it. Probably you'll go for straight line method or WDV method. WDV method is quite fine, but when you go for straight line method, the value of the asset is 5 lakhs and you see the life of the asset is for 5 years, which means what? For each year, you're going to depreciate 1 lakh. Okay, in the beginning, you have used very less, probably the machine is in a good condition. That's why that's a drawback in SLM method, right? That's why you go for WDV method. Am I right? It breaks consistency principle if method is changed. Yes. From the beginning, I was using in a different way, but now I have changed my depreciation method. So what happens? The consistency is broken. Harder to compare across years. Yes, you should not compare. That's what we did here. May overvalue asset if rate is not realistic. If the rate is not realistic, you may feel that the asset value is shown in overvalue. Requires careful estimation of useful life. You thought this will work for 5 years, and after using 2 or 2.5 years, the machine has gone for the 3 years itself. Which means what? Your complete calculation has gone wrong. Okay. Recommendation is suitable for vehicles, but consistency and comparability must be considered. What are the suitable depreciation methods when we go for land? Land is actually a non-depreciable asset. Okay, it will not wear out. Obviously, to say that the value will be increasing. Fixtures and fittings, you can go for straight line method because it's a steady use and it's a predictable wear. Loose tools will go for revaluation method because frequently it will be replaced and all small value items. We'll go for BRS, bank reconciliation statement. What are the advantages and why we prepare this is you get the actual bank balance availability. If any errors are there in the bank statement, that could be easily identified by doing this BRS. Errors in the cash book is also identified and it will help us to detect the fraud and embezzlement. What do you mean embezzlement? Taking out the cash with no permission. Checks not presented identified. Okay. Deposits not credited by bank is also identified. And stale or outdated checks is also identified. We'll go for bank OD. It is shown as debit balance on a bank statement. Why? The reason is when we talk about OD, which means, see, when we talk about the non-performing asset, we give a loan to the outsider. Bank is not we, sorry. Bank is giving a loan to Mr. X, which means what? Mr. X will be repaying the loan, which is an asset. The same way the OD is also an asset. It is an asset to the bank, so money is owed to bank. It represents liability for the business and shows withdrawals exceeding the deposits. Clubs, receipts and payments account, there will not be using profit and loss account, right? For non-profit organization, non-government organizations and all, will be using the term receipts and payment, okay? Or income and expenditure, what you see. So it's an annual summary of club's cash book. Accumulated fund will be nothing but assets minus liabilities, or what you call as accumulated surplus minus the deficits. So you have two ways you can do it. Assets minus liabilities or accumulated surplus minus deficits. Partnerships and limited liability companies. Already all these contents I remember we have done in business studies, right? Partnership disadvantages of operating a partnership. Profit is shared among the members. There are 3 partners, X, Y, and Z. Who is sharing? X is doing all the business. Okay, he's not sleeping at night at all. Okay, he's doing all the business, taking care of the business. But who is sharing the profit? Y and Z. Because they say because we also have invested in the business. Decisions must be agreed jointly because X cannot take the decision individually. Slower decision making, disagreements can occur sometimes, and one partner's action will bind all the partners and unlimited liability for debts. Yes, if anything happens or if anything goes wrong, then it has to be taken care of by all the three partners, not only the X, even Y and Z. Lack of continuity if a partner leaves or dies. See, that's why we say that partnership is the business and owner are safe. You remember? Business and owner are safe. Partnership agreement, usually they will have these terms on interest on capital, interest on drawings, I think. You can please correct it. And about the partner salary. Other related items can be capital that is being invested by each partner and what is the limit on drawings and interest on partner's loan. If any partner is borrowing an amount from the business. Partners reduce drawings and continue business for long. Reason to reduce drawing to avoid a debit balance, keep cash in business and reduce interest on drawings. Principle for continuing indefinitely. So what principle they follow? Going concern. Actually, when you talk about corporations, you can talk about going concern. For partnership, usually we should not talk about the going concern. But what happens is, with that support only, we run the business. So here is a practical case law. Is offering them a partnership. For offering partnership, on what basis they will see? See, there is already X, Y, and Z. Now, Mr. R comes inside the business. On what basis? Okay. Probably his skills and experience may be benefiting the business. That's why I include you. That is R in my business. That might be attracting more customers, and because of that, higher revenue and profit will be gained. And not only that, workload may be shared and risk is also shared and could introduce, that is, you can bring in capital, right? R will be bringing in capital. And if he's a well-known person, less advertising is needed. Okay, and I'm inviting Ambani to my business. Chef to my business. Okay, Sundar Pichai to my business. Okay, they're all our friends only, we are inviting him to business. You need not worry about the profit, you need not worry about the customers. Okay. See, well known. Less advertising is needed. Something is against what? Even though well known, okay, you'll be like conjunced to share the problem. Okay. Rates 20% share is more than the employee salary here. So definitely we have to worry about that. Significantly reduces partners' collaboration and must consider how his views will be. Sometimes he will not be okay with the other partners, so there may be some possible disputes arising. Liability for crimes of actions also because he is doing some action and the whole business is getting affected and they'll be liable. Forming a limited company is easier to raise the funds. The advantages I'm talking about. Separate legal entity and limited liability for shareholders. Continuity of existence and improved reputation. Disadvantages, higher admin cost. Yes, there are so many legal provisions you have to follow. Costly to establish, more legal requirements and complex accounting on annual statements and more info made public. Yes, you have to, most of the cases you have to reveal the statements. For example, balance sheets, right? Financial statements itself. Partnership versus limited liability, which is better or like what has the betters and goods and bads, right? Positives and negatives. Advantages of converting. So partnership to this one. Limited liability will be for shareholders. So just remember, already X, Y, and Z are the three partners, and they have converted this partnership from business to company, a limited company. So in the case of firm, they were having this unlimited liability, but once it is being converted as a company, the liability for the shareholder. Here, X, Y, and Z will be not called as partners. Instead, they'll be called as what? Shareholders. Okay. Separate legal entity concept will be followed. There will be an improved reputation and standing for the business, and continuity of existence will be there. This going concern will not get affected here. Whereas in the partnership, it is totally different. Disadvantages, more complex accounting, annual financial statements, everything. You have to follow that principle, etc. More legal requirements we have and costly to establish, and the administration cost is also high. Next, let us go for the suggestions. Could SSI Limited employ consultant for credit control? Yes. Why? No. Why? Okay. Yes, in green color. Better trained staff, faster debt collection, so the cash flow will be improving. Reduced irrecoverable debts, stronger credit control procedures, one-time fee, long-term benefits, and may improve customer screening also. Disadvantages, consultant fee. Yes, obviously we have to pay. Possible damage will be there for customer relationship if something not going well. Risk of reduced sales of stricter credit terms, no guarantee of improvement, staff training may disrupt operations and additional hidden costs is possible. Recommendation, worth considering if debt problems are serious and benefits outweigh the cost. Supplying drama school, so it supplies costume on 60 days credit and the credit period is now extended means. If you extend the credit period, what will happen? The sales and revenue will be increased. So there will be an ultimate potential increase in profit and security or continuity of workload will be there. Okay, so that will be obviously there. You have to make a follow up. Opportunity to expand to other schools or theatre groups also builds reputation in new market and long-term contract will be providing stability. Whereas there'll be an extra administration cost, may need more manufacturing or storage capacity. Risk of overstretching resources will be there because now you're getting the order, but in future you're not getting the order. What will happen to the business? 60 days credit weakens liquidity. Yes, if I'm extending the credit, which means I'm not going to get the money immediately. Higher risk of irrecoverable debts and possible cash flow problems. Recommendation, accept if capacity and cash flow can handle credit terms. Increasing trade payables period for advertising, payment delaying for expenses and used for cash for advertising. Use the cash for advertising. So when you talk about advertising, we have like advantages is attracting new customers. So that's why we have an impact that sales is getting higher and the profits are increased. No need to use existing cash or bank balance or inject more capital. It will avoid loan or overdraft, no interest cost, and advertising useful for new business also. But whereas when you talk about advertising, it always need not end up in sales. Okay. Sometimes because of cash discounts, we will be losing the suppliers. Suppliers may charge interest on overdue accounts and damage the supplier relationship will be there because risk of supply cut off. Recommendation, what you can do? Balance short-term cash benefit with the long-term supplier test. Cash benefit with test. Profit margin decrease and increase. If the collection period is long, then higher risk of irrecoverable debts. Right? Obviously, if you're extending the credit there, so there may be a higher case. Increase the provision for doubtful debts, so profit is reduced. Delayed payments to trade payables, so you'll be losing the cash discounts and overdraft may arise, which is charging extra interest. Trade payables may charge interest if late. SS Bank's loan for expansion, you take it or leave it. For loan expansion, obviously we can go for potential profit increase. 5 years will be allowed for repayment planning and once repaid, there is no liability. So that will be improving the market share. Even though these are the advantages, there are some disadvantages against the loan also. So you have to pay the interest. So obviously it's reducing the profit. Bank may require security. So assets will be at risk and loan must be repaid regardless of success and bank may refuse loan and increase the financial risk. Recommendation, take loan only if expansion plan is realistic and if the payment is feasible. Else don't go for the loan side. Next case, SSA is buying premises with long-term loan. So what is the advantages behind this? No rent is payable. Yes, I'm happy. I need not go wait for the owner will be standing for each and every month's payment. Avoid future rent increases. So today is $1 lakh, but tomorrow it will not be $1 lakh. It's definitely increasing. It will be cheaper in long run. Yes. Ownership, adapting the promises or rent out. Long repayment period will be there. No obligation after loan repaid when property may appreciate in value. Property will be appreciating in value. Disadvantages, interest cost will be there on loan. Loan repayment obligation will be there. Loan will be secured or assets are risk of default and responsible for property maintenance and interest rates may rise. Yes, that's a disadvantage. Financing expansion, whether you go for debentures, issue of debentures or issue of ordinary shares. When you talk about debentures, annual interest is payable, fixed or proceedable. Liability must be repaid before the shareholders if it's planning for winding up. No voting rights for holders, no dilution of shareholder control, interest payable regardless of profit and may be secured on assets and may not raise adequate funds. Ordinary shares, dividend may be paid, not fixed. Do not have to be repaid. Probably repaid after debenture holders if wind up. It will be carrying voting rights. Possible dilution of control will be there. Dividend depends on profit and director's decision and may take longer to raise funds and may not raise adequate funds. Now we'll go for the next content. SSA is now producing own goods or is now planning to buy finished goods. Just remember, SSA is running a poultry farm in a hill area. It's better that we buy the chicks and wait for 3 months so that the chicks grow old and sell it. Or this is just 1 month chicks. After 3 months, we are going to get almost a double or triple times the amount. This option is good. And what are you going to do? You buy the finished goods. You buy in one market, okay, for $500, and you sell it. Take it to other place in weeks period. You sell it for $500, $700 immediately. So this is better or this is better? We'll check. Okay. Advantages of producing own goods. Independence from supplier. Continuity of supply. If I'm having the chicks, then I can grow the chicks organically. Am I right? More control over quality, more control over cost, potentially more profitable or cheaper. Economies of scale, not all price, not cost price proportionally. And reduced returns. Finished goods had high returns. Disadvantages: higher factory running cost, need for new machinery, so capital layout will be there. Factory capacity may not meet the demand. That's a big drawback. Risk of surplus inventory if demand falls and purchased goods may be better quality. Sometimes it happens too. Refurbishing the shop. Why you need to? You keep it attractive. Why? The customers will come for the attractive. So the profit will be higher and sales will be higher. Keep up with competition for the modern look. So you want to go for a cafe with your friends or parents. Which shop you go? A shop with proper tables, lightings. You go to that shop or you go for a shop where the tables or benches are shaky. Right? If it has a modern look, then you'll feel like good, right? Feel good shops. More efficient and better working conditions also will be checked. May justify higher prices, yes. Could increase rent charged to subtenants. Disadvantages: requires extra capital, loan or overdraft, may need to raise prices to or cover cost, higher expenses, probably interest or depreciation, that will be lowering the profit. Risky if property is rented, so that's also a problem. And current fittings only for 2 years old. If I refurbish my shop, for after 2 years, it will be like it is getting old. We have to change it. May not actually boost sales or profit. You are planning that it will be boosting the sales, but it's totally the reverse way. Only refurbish if competitive pressure is strong. Yeah, when it's recommended and you're financially secure because you're investing. You know this that in India we have a shop in Tirunelveli, Halwa Kadai. In that shop, there is no table, there is no chairs. That shop name is Iruttu Kadai Halwa, which means dark shop. You can check in there. There'll be a small bulb hanging over. The shop will be open only after 6 p.m. After 6 p.m., the sun will be set so that it will be dark and a small light bulb will be there. And they'll be selling, they're doing the business in crores and crores. Only selling wheat halwa. Tirunelveli, Iruttu Kadai Halwa. Okay. If they want to modernize the shop, they want to bring good lightings and all. They want to have tables and IKEA tables and other things. They want to bring that look. Is is that going to helpful? Is that going to be helpful for them? No. Let us go for the next content: injecting more capital to reduce overdraft. A decision on personal capital to pay off overdraft. What are the advantages? Improves liquidity, obviously. Obviously, the cash flow is increased. Reduces interest and charges. Improves relationship with the bank. The bank manager will come. He will give the OD and go. Right? Provides funds for expenses or payables, strengthens financial stability, and may improve credit rating. Disadvantages are also there. Reduces personal funds available, may lead personal loan, more personal risk if business fails, loss of interest on personal investment, could create dependency on personal injections, and may affect lifestyle or financial goals. Recommendation: only if surplus personal funds exist and business prospects are wrong. Selling office equipment to pay supplier. Why you sell? Because the supplier is often giving this tension to you. You want to release the fund. That's why. Reduce supplier interest charges. So you have to anyway pay the charges, right? Maintain supply relationship. Once you pay the money correctly, obviously, then he's going to maintain the relationship and you'll get the stock in time. The inventory is in time, raw material in time. Profit on disposal sold for 2,500 and the cost is 6,000. It is fully depreciated. May not affect profit earning ability. New equipment can be bought later. Definitely. Which is selling the equipment we can buy later. Against the selling, still they owe balance, not full payment. Sometimes it's a little, you have to pay now. But selling this equipment, you are not taking the full amount. So obviously, what you have to do, you have to go for taking for selling other equipments. Risk of damage is there if the supply relationship is not maintained. May hinder efficiency without equipment, replacement cost higher than debt owed, and could explore alternatives like receivables, or you can go for bank overdraft or capital injections. Reducing selling price to increase sale of unsold inventory. Reducing selling price to increase sale of unsold inventory. If there's unsold inventory and you don't want to reduce the selling price, at one point of time, what happens? See, they say that year-end sale, year-end stock, clearance sale. If they are not selling it, probably if it's not sold at all, what happens is automatically the product goes old and will not be having the stock. Okay, the product goes old, be having the stock. Which means what? You don't get the profit. For reducing price, it increases quantity sold. So number of units you sell will be increasing. So you see this car companies and all, Toyota and other companies. What they do is at the end of December 20 to first or second Jan, what they do is they drastically reduce the price of the car because, for example, we are in the year 2026, 2026 December. Okay, if not sold, now we are in 2027. What happens? 2026, they say it's 1 year old model. You cannot buy the car. Will you buy a old model car? Definitely not. Reduce inventory levels, improve inventory turnover, and lower risk of unsaleable or damaged stock is there, and reduce storage costs and increase cash inflow. Reduce the overdraft. See how the impact is there. And improve the liquidity. Is it okay? Against gross margin may be falling. Less cash per unit sold, and customers may resist paying full price later. Now let us go for ratio analysis. We have to come in. Gross margin is improved, which means selling price increases, which means what? Discount decreases or cost increases. When we talk about liquid test or asset test ratio, this version means more funds tied in inventory, which means liability is increased or liquid asset is decreased. Increasing subscriptions for computer equipment. For increasing subscriptions, probably subscription unchanged for years. Increase expected. Small rise enough to raise for $400 and no need for loans or interest. Club efficiency may improve. There are some against points also. May be unpopular with members. Risk of members leaving or joining other clubs. Membership already failing. Sorry, uh, reduced. Okay. More arrears or write-offs possible and could raise funds another way. So reduce expenses, loan or fundraising. Amadi, the rental premises versus hectare, the own premises. We'll go for the profit margin comparison. See, we have already done this one. So whether I want to own a property or rent a property, okay? So hectare profit is more than Amadi's profit. Similar gross margin, so expected in same trade. They have the similar gross margin. Say they are in the same trade. Hectare's higher profit margin explain more premises why. See, hectare profit is more than Amadi's why? Because he's having his own premises, no rent. See, the profit margins are same, but profit is sorry, gross margins are same, but profit is being higher for hectare. Only repairs and maintenance is his going to do, but for he has to pay the rent. That's lower in the profit margin. So, his business are reasonable under the given conditions. So far, is buying inventory at discounted price. So has insufficient cash and it is ceases his trading. So supply relationship has been broken. Okay. For buying discounted inventory, leads to profitable sales. Extra inventory, more customers or revenue, completed goods, quick cash conversion, and own finished goods stock has fallen. Scope to sell, more may be there. Against buying, insufficient cash, borrowing, the interest charges. When you go talk about storage costs, now you have to pay extra. Risk of unsaleable or poor quality goods may be there and higher selling costs. There is another one case with Ajay. Gross margin increase and financial statement for customers. Reason why gross margin increase. Okay, increase. Purchase price decrease. Trade discount is received, or sometimes sales mix also change. What you call as the way you define it. Why customers pay the financial statement? To know if Ajay can continue supply. Okay. If Ajay can continue supply. Ajay's realistic selling price to ample level of inventory and trade receivable advantages. It can increase the sales and also new customers will be there, so they are attracted. May increase annual profit, faster inventory turnover, lower risk of accident or damage stock, and reduce the storage and insurance cost, and it will improve reputation also. Disadvantages: gross margin of profit is reduced, so there is a possible loss also. Less cash per unit, so the liquidity is reduced. Customers may doubt quality, so reputation is under risk. Customers may resist full price later, and better option like offering like a cash discount to reduce the receivables. Ajay, falling profit margin despite gross margin increases. See, you must be very confident about the term gross margin and profit margin. Okay. So rising expenses leads to risk of losses and may struggle to pay supplies and wages, and businesses cannot continue indefinitely if trend persists. Choosing suppliers offering one cash discount 5%, or will you choose a supplier offering trade discount 3%? What you will do? Let us go for the first option, cash discount. I pay 100 rupees. 5 rupees is cash discount. So how much you're going to pay? 95 rupees. So offers cash discount 5%. Cash discount percentage is greater than 3% trade discount. So you go for option 1. You will maintain good relationship with supplier 1 and familiar with supplier 1 quality and reliability. You know about the person already. He's not going to sell the cheap quality or whatever it is. Then you can go for cash discount. Okay. Disadvantages. No trade discount from supplier. Okay. Risk of, what do you mean by trade discount? You pay 100 rupees, but you get the goods worth 103 rupees. So, okay. Risk of losing cash discount if late payment, yes, that's also is there. If I'm not making the correct payment on time. Dependence on one supplier and no incentive for supplier to improve the terms of supplier one. Then we can go for option 2. Depend on both the supplier. Supplier 2 offers trade discount, so directed upfront. That's right. Lower cost of goods from supplier 2. Not dependent on one supplier. Okay, see, you're depending on both the suppliers. Supplier have a better terms to compete. This obviously supplier will try to do that. Okay? So, recently we have in Alliance Friends, for 50%, which means what? You purchase for 5,000, how much will you pay? 2,500. Instead of this, they are giving one more discount. You shop for this, you get this garment free. You shop for 3,499, so approximately 3,500. You get the garments 3,500, which means what? You shop for 7,000 and you pay 3,500, which means what? The same only, no. But in this case, when it is 50%, what you'll do? You'll buy for 2,000 and pay only 1,000. But in this case, definitely you'll buy for 7,000. So there's a lot of things. Disadvantages: supplier 2 will never give cash discount. Am I right? They'll go for the MRP price of this. Trade discount is less than supplier's first cash discount is already discussed. May damage the relationship with supplier 1 because I'm going for the supplier, right? I'm not considering the supplier 1. I'm familiar with supplier two's quality and reliability. How I don't know how far his goods will be. So next one is trade discount 10% and cash discount 3%. What to offer? Trade discount will encourage regular or repeat orders. Yes, obviously. May increase revenue and gross profit. Builds customer loyalty. Simple incentive for bulk buying. But you have to be very careful in recording eligible customers who are those. One-off customers may feel overcharged. If unsuccessful, then definitely that's going to be reducing the revenue or profit. Cash discount encourages prompt payment, which is obviously going to improve your liquidity. Reduces risk of irrecoverable debts. Less money received overall. Reduces net profit. 3% may not be enough in certain cases. What happens? And may complicate credit control. So what you can do? Cash discount improves liquidity. Trade discount builds loyalty. So choice depends on what type of customers you're going to attract over here. There is one last case. SSA's advertising and pricing strategy. So you want to lower the price. So what happens? What is the impact here is, why we want to consider this one here is gross profit margin lower than the competitor. So if it's a negative angle, right? Increased advertising, so the expenses are now higher, so that's lowering your profit. Selling faster is not equal to higher total sales than competitor. Needs higher volume to offset the lower margins, and risk of unsustainable pricing strategy is there. But still, you want to reduce the price. Higher sales volume may increase gross profit if sufficient. Is that okay? So that's the content repeated in the past question papers. Thanks for joining.